everyone, and welcome. We are delighted to have you all with us today. My name is Nicola Corzine, and I am the founding executive director of the NASDAQ Entrepreneurial Center. We have an amazing conversation in store today, and we are so grateful that all of you are joining us. Now, for those of you who may not know, the NASDAQ Center is a nonprofit committed to enabling entrepreneurs from all over the world to realize their maximum potential and thrive. And we're hoping to do that with some great insights that are going to come out in today's conversation. Now, the NASDAQ Center, as you may have seen in our launch video, along with our partner Mentor Cloud, is launching a major new initiative right now, a movement called Mentor Makers. And we don't do anything small because we get to work with entrepreneurs. So by no means is this movement small either. We aim to deploy more than 1 million mentor hours to more than 50,000 businesses in this time. We know how much our entrepreneurs are doing and how struggling they are. And so we want to be able to help them do even more through the art of mentorship. We would love to get you involved though, because to deploy those kind of hours and to make that kind of commitment means that we need all of you to play a part. And so what we'd love to invite you to do is please take just a moment to tag one or more of your mentors on social media who have made a difference in your lives, help pay it forward and recognize their contributions, and tag us. Do the hashtag Mentor Makers and tag us at NASDAQ Center. And by acknowledging your mentors, we're going to hope that we encourage others to do just the same. And please be sure to sign up if you need some extra mentorship, some extra help, some extra responsive support right now. We have amazing people that are willing, waiting, and on the sidelines to support you in this time. Now, as a reminder, we're going to be opening up for Q&A throughout today's session. So please, as you have questions, pop them into the chat that you'll see at the bottom of the screen, into the Q&A at the end of the event. And we are going to try to get through as many of those questions as we possibly can. Of course, before we get started, I have to take a moment to recognize our amazing sponsors and contributors. Without them, none of this work is possible. We are as I say, public nonprofit, so we need every single dollar of their support to do this work, and we're so grateful for them. So to NASDAQ, Lehigh University, Bank of the West, KPMG, Wilson Sonsini, Woodruff Sawyer, BPM, NZTE, and Microsoft's for Startups, thank you so much for all you do for us. We're truly humbled by your contributions. Now, before we get going, we've got a couple of polls that we've been launching literally since the beginning of this pandemic. And today we're going to go ahead and launch the same polls to just get a quick sense and a sentiment as to how all of our entrepreneurs are doing in this time. The first one that we always like to launch with is what we call our entrepreneur sentiment poll. We just want to get a stance as to how you're feeling in these times. So what you're going to see on the screen right now is just a real quick indication. Just answer it honestly as much as you can. It has been a long year, and even as we were lamenting before jumping onto today's session, 2021 is right around the corner, but we know that the challenges of this year are still with us, and so we'd love to just get an understanding as to how all of you are faring in this time. Health and wellness is so critical to all of our entrepreneurs, and we appreciate your interest and your perspective in helping us understand that. We've got about a pretty good blend, so I'm going to go ahead and end this poll. Not surprising, some of them right now about 38% in the surviving, but a healthy dose of optimism as to be expected from working with entrepreneurs. So I've got another poll that I'm going to launch up next, just to get a sense as to what is keeping you up at night right now. For those of you who may not be as familiar with the center, what you should know is that we are a responsive programming center, which means that as much as you tell us what you're struggling with, we commit to building those programs. We commit to bringing in experts that will help you overcome those challenges. So what you're giving us today is going to show up on the docket in January and February. So thank you for helping us deliver those kind of programs, deliver those kind of insights that you need. At a pretty good point, not surprisingly, finance and sales is right up there, along with also scaling and team. So let me share those results really quickly. And then let's get to the good stuff for today. So I have an amazing panel that we're incredibly fortunate to learn beside today. Craig Sherman, partner at Wilson Sonsini. We've got Jacqueline Hester joining us today, partner at the remarkable Foundry Group, and James Wang, a general partner at the amazing Creative Ventures. It's awesome to have you all with us. Thank you so much for your time. I'd love to invite each of you to maybe just give a real quick introduction to who you are. And then I think we're going to go into some great slides and a quick overview on what has been happening within the venture landscape this last quarter and 6 months. So Jacqueline, can I invite you to go first, if you don't mind?
Sure, Nicola, thanks. And thanks so much for having me. It's great to be here today. I'm Jacqueline Hester. I'm a partner at Foundry Group. We are based in Boulder, Colorado, but we invest across North America. both in smaller seed stage VC funds, that's about 25% of what we do, and then directly into early stage tech companies, which is about 75% of what we do in our primary business. We've had a wild year, and we're very much looking forward to 2021, but we feel super fortunate that we're sort of getting through 2020 unscathed.
Here's to wild years, huh? Thanks so much, Jacqueline. It's great to have you with us. James, over to you next.
Sure. So I'm a GP at Creative Ventures. Creative Ventures, we are an early stage deep tech fund trying to set a new standard around a more systematic and methodical method of investing, especially in early stage. We target the largest secular trends out there, including demographic change impacting healthcare costs and labor shortages, as well as impacts from climate change. And my own background's both on the finance side, on the investment team at Bridgewater Associates, as well as tech, doing a stint at Google X, founding my own consumer health startup, and still being an active reviewer at various tech publishing houses.
Amazing. We cannot wait to lean into some of that expertise today. So thanks so much for joining us. And Craig, please round us out. And then if you will indulge, I can't wait to see some of those slides and updates on how this industry has been faring over the last 20 months.
Absolutely. Great to see you all. I'm Craig Sherman. I'm a corporate securities partner at Wilson Sonsini, Goodrich & Rosati. We're a law firm that is focused on representing technology companies from the very earliest stages through the IPO and beyond the IPO. And as we're going to talk about here in a bit, we're extremely busy these days with every stage of development, with a tremendous amount of activity. I've been practicing law for about 31 years. I work primarily with early stage companies, but they start early stage and then they get big real fast. And that's what keeps me busy all the time, other than my kids. And why don't we dive in and give a little bit of background? So every quarter, we pulled together data from all of the deals that we work on for venture-backed companies, and we publish an entrepreneurs report. I think a link is going to be distributed to the full entrepreneurs report that goes into quite a bit of detail on surveying individual market terms, terms of liquidation preference, anti-dilution protection, all the lawyerly gobbledygook that is super important when you're negotiating a financing. But to kick off this session today, I really wanted to focus on some of the high-level takeaways from our most recent quarterly survey for Q3 of 2020. So why don't we jump, Isis, to the next slide? So here we track, going back over the last 5 years, up and down rounds. So up rounds meaning financings at a higher price per share than the previous round, and down rounds meaning financings at a lower price per share than the last round. And what you see here is actually a surprising level of consistency over the last 5 years. And for those of you who attended this same webinar a quarter ago when we talked about Q2, I think we were all quite shocked that in Q2, when COVID really kicked in and we all started working from home, there was an expectation that there would be a real uptick in down round financings. And down round financings can be quite complicated. You hear people talk about washout financings and other nasty terms to describe a financing where existing investors really get punished if they're unable to participate in a financing and write a new check. And so we spent a whole bunch of time training our associates, who many of whom have been at the firm for years, but hadn't been through a down round financing. Because again, if you look at this going back 5 years, it's very constant. There really aren't that many down round financings. If you go back another 5 years, it's pretty similar. But if you go back to 2001 and 2002, after the dot-com crash, all we were doing was down round financings. And I would say this chart was almost flipped, where more than a majority of the transactions that we worked on at that time were at lower valuations than the previous round. But here you can see the good news that, as I said earlier, in Q2, things continue to be healthy. Most rounds, well over 80% of rounds were up round financings. And you can see in Q3, it was even better, that we're close to 90% of the financings that our firm worked on, either representing companies or investors, were at an increase in valuation over the last round. Isis, why don't we jump to the next slide? And this shows you valuation. So interestingly, if you look at valuations for late stage financings, we peaked in the first COVID quarter, Q2, where valuations for late stage financings averaged, or the median was over $330 million. In Q3, that came down a little bit for late stage financings. And for earlier stage financings as well, you can see that valuations continue to be high. For Series B, 98 million was the median pre-money valuation for Series Bs. For Series A's, it was close to 30 million, and for seed financings, almost 7 million. And it, in some ways, it's more interesting to look back at the trends year to year on the left side of this chart as you're looking at it. And you can see the dramatic increase in median pre-money valuations for all levels of financing over the last 5 years. Let's jump to the next slide, Isis. Okay, here we go for the median amount of money raised in a bridge loan. So for those of you who don't know, a bridge loan can be a convertible note or a safe financing. There are different structures of an interim financing between priced equity rounds where the valuation is not set. And you could have financings that are done before the company has ever raised an equity round, and that's the blue bar on this chart. And then the kind of orange-red bar is for financings that are done in between equity financing. So there's already been at least one equity financing, and there's a bridge in between from one equity financing to the next equity financing or to a possible sale of the company. And you can see the numbers again here are quite healthy. Interestingly, in Q3, the dollar amount, the median amount raised in bridge financings actually dropped significantly. And I think that's because we're in a very healthy equity market right now. We were in Q3, and at the end, I'll talk a little bit more about what we're seeing in Q4 so far. But I think that we saw a decline in the dollar amounts raised in bridge financings between rounds because it's a very healthy market for raising equity financing. So you normally would see the amount raised in bridge financings increasing where there's nervousness about how long it's going to take to the next round. Companies are hitting the wall and they need to raise a meaningful amount of money in between financings. Here are many companies, the companies that are healthy and able to raise money have generally been able to raise equity financing. So the market, this is another sign of a healthy market. And I think that's it for our slides. So let me talk a little bit quickly about what we're seeing so far in Q4. So we've got about 3.5 weeks left in the quarter, but basically every deal that's going to get done has either closed this year or the term sheet's been signed and we are scrambling, and lawyers are extremely busy these days trying to get financings closed by the end of the year. I have not in my career since 1999 had so many deals where the term sheet got signed and we're trying to close by the end of the year. It's going to be an extremely busy end of the year. In a perhaps a sign of a peak market, which does worry me. And again, this feels very much like 1999. It has not been unusual in the last few weeks for us to have clients sign term sheets with investors 2 or 3 weeks after the first meeting by Zoom, of course. The founders and the investors never having met in person. Term sheet gets signed in 2 weeks, and then the money's in the bank or is supposed to be in the bank within 3 weeks. And so there's obviously not a lot of time to do meaningful customer due diligence or business due diligence or legal due diligence. The pace of transactions and how quickly they're getting done, I think, is a sign perhaps of a peak market. And I'm sure we'll talk about this more in the questions as we go. And in terms of the deal terms, obviously we don't have the numbers yet, but I expect that valuations are likely to be at record highs in Q4, and the amounts being raised are likely at record highs. We have quite a few transactions that we're working on where companies went out to raise X amount of money, and the investors said, please take 2X, and we'll increase the valuation to make up for it. So it is a very strong, robust, perhaps irrationally exuberant market right now.
That's the rightful phrasing, wild year for sure. Um, well, on that note, thanks so much for the great backdrop. Obviously, sets the conversation today in really interesting ways. We've got a few questions that we're going to run through, and then just a reminder for everyone joining us, and thank you all for your time and support today. Please make sure to go ahead and pop those questions into Q&A as we go throughout today, in whatever way that you hear, and we'll try to get to as many of those as we possibly can. So, Jacqueline, I want to start with you. First and foremost, congratulations. You are the newest partner, I think, in Foundry Group. It's awesome to have you on that great team and that great talent stack. But Foundry's kind of an interesting model, right? You've actually got kind of this two-pronged strategy, like you talked about at the start, both as direct investor and then also as investing in emerging fund managers. Would love to learn just a little bit more about the types of companies and also the types of funds that you're focusing in on investing in, and also PS, kind of what inspired you to join Foundry, besides the fact that there's amazing venture group out there, but would love to know that story too.
Sure. I guess I'll start with the last question to sort of lead into to our strategy. So I joined Foundry almost 5 years ago. I had been practicing attorney, and it just wasn't the best fit for me, I think, given sort of where I ended up, big firm, big M&A practice. And I had spent time with startups in graduate school. I did my JD and my MBA out here at CU, and that was sort of the Boulder community, and really actually Foundry having catalyzed our startup community here. Once I was exposed to that, and then also my husband and his family did a startup together called Fair Harbor, which was sold a couple of years ago to Booking.com. So I sort of lived the entrepreneurial journey with them. And so with all of that experience, I really wanted to be closer to startups. And so when I decided that I wanted to make that shift, I just sort of had really good timing. And one of my partners, Lyndall Ekman, was coming into Foundry Group at that time to sort of institutionalize this strategy of us investing in other VC funds. And so, yeah, I would say my timing and my karma was good. And so they brought me in to work alongside Lyndall for the first couple of years, building that partner, we call them partner funds, our partner fund portfolio. So the first time we did that was in our 2016 fund. And we basically took up a network of relationships that were mostly already existing, both between my partners and relationships Lyndall had from his prior career at the University of Texas Endowment, and just bringing friends closer and sort of institutionalizing it, giving our LPs the exposure to what we thought would be a great portfolio just from a returns and performance perspective for them. You tend to see more alpha in these small, early funds, as well as sort of the network effect of the deal flow for us. And so we almost think of ourselves as a distributed firm, where instead of having lots of principals and associates and all of that, we've stayed pretty lean as a partnership. And so we almost think of our partner funds as an extension of us. Most of them are investing at pre-seed and seed, sometimes Series A. And so we typically enter more around Series A or a little bit later. And so we think of it as a sort of a perfect a filter for us, really. We don't necessarily need more deal flow, we need help filtering. And so that's sort of how we work with our partner funds. On the company side, we're thematic investors. We think of it pretty horizontally. So as opposed to sectors, we focus on themes. So marketplaces, for example, a company called Rover that Craig probably knows well because it's out in Seattle. Human-computer interaction. So an example of that is Whoop, which is a company that's doing great right now that we're invested in. Fitbit was probably the precursor to that. Glue, computers talking to each other. So they're all pretty broad. But we sort of like to see early stage tech companies based in North America focusing on big markets. We, love great founders, who doesn't? And so that's sort of where we play. And then on the fund side, the funds have mostly been sub 100 million. We've done some of our own peers. We've done some sort of middle tier established funds that are maybe on fund 3 or 4. And then a place that I've been focusing recently, in addition to the work that I do on the direct investment side of the house, is sort of building out our emerging manager portfolio. So you'll see us add a little bit in that category, but we're pretty built with our 32 partner funds today.
That's a great overview. Thank you so much. Now, James, over to you. Creative Ventures is known as a problem first fund. I absolutely love that. Tell me how you think that through, then, when it comes to both your investment thesis, what you're looking to invest in, the types of companies, and then equally the kinds of entrepreneurs that you typically are wanting to meet, and how you even meet those types of entrepreneurs.
Yeah, so, and I think that's a great characterization, since a lot of folks look at our website, look and see we have a lot of deep tech there. So quantum computing, even AI, robotics, that sort of thing, and see that we have a lot of engineers and PhDs on our team and assume that we care most about the technology side. But as I sort of alluded to in the introduction, for us, it's really these big secular problems that interest us. So if you look at the data, it isn't usually the case where it's like these companies are failing because they, did some sort of execute, like the root cause is not usually just a pure execution issue. Even with we ran out of money, sales aren't going as well as we thought. Usually that traces back to an issue in terms of the market, product market fit, not finding the right model to penetrate that market. So that's where we see companies usually fail, and that's where we're particularly interested, just in terms of addressing these problems. It just happens to be the case that a lot of the areas that we play in terms of like healthcare costs or labor shortage issues, if there was a good technology solution in more traditional technology, it usually would have been adopted already. So for us, it's really adapting a lot of our research to looking at these big pressing problems, and less the technology side, which just happens to follow along, and our technical backgrounds helping us just diligence those companies. So one example, we have two MEMS companies within our portfolio, so micro electronic mechanical devices. We didn't invest in them because they're MEMS. Yeah, they have some aspect where their architecture basically helps them have far lower costs, but our company's Echo, EXO, which is a portable ultrasound, so it can do things for much cheaper and can be comparable to laptop machines, or Sense, which is able to essentially use MEMS to address the LiDAR market and not need to use the traditional sort of cameras, mirrors, other things that you need for LiDAR. We invested in them because of the trends in healthcare point of care and necessity to basically do rapid diagnostics and more diagnostics with less radiation, and just addressing healthcare costs there, and also focusing on the LiDAR market because of its needs within the robotics and autonomous vehicle space, driven by a lot of labor trends there. So even though there's a lot of technology in it, our fascination is with the problems, with the technologies being a solution to them rather than the other way around.
I love that framing. Love that framing. Okay, so PSA, not that any of us need it. I know nobody here has a crystal ball, and I completely understand that we do not know how the next quarter is going to unfold. However, Craig, I'm still going to ask this question, and that is, with the vaccine on no longer just a hope, actually now timelines and deployments, how are you thinking that may or may not affect this amazing volume of deals that we've been seeing come out and these incredibly favorable terms? Any hypothesis that you're willing to offer us at this stage?
Well, I would say, first of all, it's difficult to imagine a market being better than the current market. It's hard to imagine that valuations could go much higher, although I said that 5 years ago. I also said 10 years ago that Amazon stock couldn't possibly go any higher than it is. So don't listen to a lawyer make predictions. We'll have to ask the real people. Ask James and Jacqueline about what their real thoughts on how high valuations can go. But it's certainly hard to imagine deal terms getting more company favorable or more founder favorable than they are. So deal terms are very, very good right now. It's interesting because when, as I mentioned earlier, when COVID hit, we thought that was going to have a big impact on the market, and it didn't at all. And it's, the private company funding market, venture capital, private equity, trails by, I'd say, about 10 minutes what's happening in the public markets. So I think in terms of valuations and deal terms generally, it's not going to depend so much on whether COVID has been cured and the pandemic has ended, hopefully not too far in the future, but really on what's happening in the public markets. And if the public markets continue to be strong, the venture market is going to continue to be very strong. If the public markets falter, that's going to spill over almost immediately into the venture market as well.
I think when it comes to the positive aspects of this year on the venture side, one of the other interesting elements to look at is the speed of which deals are getting done. You've all referenced that in different ways already. Jacqueline, from your perspective, when you think about things like due diligence, speed of deals, what's positively affected come out through this year? And are there any concerns or shifts in strategy that you think are going to be on the horizon for next year when it comes to how deals get done with Foundry Group and others?
Sure. So for Foundry in particular, we were in a pretty good position because of the way that we work with our partner funds. So we sort of like, as an LP on a look-through basis, we already have exposure to these founders. Often we've met them at annual meetings because they've been in our seed funds portfolios for a while, and we sort of have an insider that's already invested. And so for us, we actually had invested via Zoom prior to COVID on a few occasions, and it was a little bit easier for us to sort of to have that trust. And for the founders to have trust in us, I think, as well. So that was an enabling thing for us. I think one thing that we've seen across the board is there's some friction taken out of the, even though I think Zoom is hard, and there's certainly friction that is, that wasn't there before, that is because you're having to do things virtually. It's really hard to read body language. I think you're actually seeing things move more quickly because you're taking the travel and the need to meet in person out of the equation. You can have multiple partners, in different places around the country meeting with somebody. I think you'll see that a lot of firms that were, especially ones that were like Bay Area only for a long time, are investing in other markets. You're seeing more remote teams, so where people are doesn't quite matter as much. So all of those things, I think, I think have been positive outcomes. I think also, I don't know, this is probably a bad thing, but everyone's just like working so much because there's not a lot to do. We're not on planes, and we're all home. And so, for better or worse, I think that's where some of this, like, everything's just moving so fast and there's so many deals being done because we're all probably working a bit too muat worry about that from the mental health perspective. And so I think that's a thing we'll see. And I think as to 2021, how that changes, I think we still will be virtual for most of at least the first half of the year. We'll see how things actually pan out and change. And I think a really interesting thing will be to see, of the trends that sort of were accelerated by COVID, remote work, especially, and sort of I think what was at virtual events, all of those things, and you see a lot of companies popping up around those. It'll be interesting to see sort of what sticks and what changes and what people can't wait to get back to. And so I think there'll be some interesting writing on the wall towards the later half of the year to see how COVID has really impacted the way we live.
Yeah, no, I couldn't agree more. One of the interesting questions and actually conversations preparing to come into today's session was offered by James, and that, while in many ways the logistics changes, all of these things have been favorable in some regards, it hasn't necessarily been fair and equal to all parties. James, can you share a little bit, to the extent that you're comfortable, in sort of where you've seen some of those discrepancies or challenges perhaps arise with different types of entrepreneurs or different backgrounds of entrepreneurs being successful in raising right now?
Yeah, sure. Happy to. And I'd probably describe it as an amplification effect. And when we were talking about this off session, Jacqueline had described it as a barbell, which I agree with. So there's certain entrepreneurs, like we keep talking about, where they're actually able to raise at pretty ridiculous speeds. And at least to us in our segment, for some of them, at sort of eyebrow raising valuations, sort of getting pushed to the very edge of where it'd be acceptable and sometimes beyond. But at least just in terms of what I've seen, I've seen a lot of traditionally underrepresented entrepreneurs, which, just to be explicit about it, are minorities and women, right? Usually seem to be struggling a lot more. So look, there's a lot of different factors that go into fundraising, and you can attribute to a lot of different things. It's very idiosyncratic in various ways. Each country is different, but at least from our limited data set, one of the big things that we've seen for all the companies that have actually struggled to raise, where it isn't clearly something else, it usually is these groups that are having a lot more trouble. Now, in terms of guessing why that's the case, I mean, there's probably some aspect of it where a lot of these groups that have a lot of good access to different networks and different investors and different contacts that they can leverage and use, especially within this Zoom environment, they're doing a lot better because they're able to use those networks. And a lot of these traditionally underrepresented groups don't have as many of those. So that's probably part of it. At least for me, I'm going to also be a little bit cynical about it, in the sense that, a lot of these different racial disparity issues have been raised in profile, both nationally and globally this year in sort of broader industry. But at least for VC, the big reckoning just in terms of racial and gender divides was raised a few years ago. And there was a lot of intense pressure at that point to basically address them. And some of that's eased off since. So I think sort of a combination of these two factors are really exacerbating this. And we're seeing some numbers being put out by various groups sort of reflecting this trend. So it's not just sort of anecdotal on our side, we're seeing it in some of the numbers. It's just between being harder to reach out, especially if you don't have existing contacts, and a lot of the industry, even though there's a lot of at least theoretical focus on this area, having a lot of the pressure being taken off, I think that that's really driving a lot of this trend where you have pretty disparate outcomes, where some folks are able to raise money at extremely fast rates, at extremely good valuations. And other folks, I wouldn't actually say it's the valuation side that's an issue, it's being able to raise it all, just in terms of getting the contacts and getting in the rooms to do that.
Yeah, great perspectives. Thank you so much for sharing that. Well, speaking of great perspectives, one of the things that we do want to be mindful of, both Jacqueline and James, you have amazing knowledge sitting there right now and knowing what is working well when people are pitching you. And also, what are some of the challenges that you face or hear time and time again? So while initially I was just going to invite Jacqueline, and I would love Jacqueline to start, James, I'd love to come to you as well and think, we've got great founders listening into this, all of them hoping to raise money or in the process of trying to raise money. What are the insights, advice, guidance that you would suggest on things that are working in this time and things that may not necessarily be working that you'd encourage them to think differently about? Jacqueline, let's have you start.
Sure. So one thing I think that's super challenging is team dynamics and getting a read on team dynamics when you're not in the room with people. So like I'll even highlight on the investing in VC funds themselves. I think we might have some VC funds on here. It's like if you're sort of between a new team or a solo GP and you've only met them via Zoom, it's almost easier to go with the solo GP because you don't have to vet the partnership dynamic. It is really hard to do without people being in the room and without being in the room with them, especially for a newer partnership. And it's probably similar for companies where if the founders, if they're brand new to each other, there's not meaningful work history. And so it's all about building trust and credibility. And so it's like, where do you get those things? And usually it's from actually physically spending time and understanding the team dynamics. I think a lot of times when anything fails, it's because of the people, right? It's the team dynamics really. And also when things go great. And so, I always say companies are just people with a fictitious entity, right? So I think that's been a real challenge. And so whatever you can do to get in front of investors in a way that sort of highlights, so be really polished on, who's going to say what, and no weird body language when you get asked a hard question. Really prepare for the hard questions so that you know what you're going to say, and that nobody's face is like, ooh, and so I think that's an important thing. And I think just, being polished all around, because again, you're trying to create credibility and trust where you don't have necessarily an existing relationship. So you're like, it sounds silly, but your deck should look really good and there shouldn't be typos in it. You should have really concrete answers around your market size and your go-to-market approach. Things of that nature. And I think things that also build credibility are your ability to take feedback and your ability to admit where you don't know something, or like this is a challenge of our business and you're right in flagging it, but here's how we think we address that and mitigate that. So I think it's really about trust and credibility. I hate the effect that this is having, but it really does help to have warm intros and to work through networks to the extent you can. I think many of us are really focused to the point that James made earlier on making sure that our networks are inclusive as they stand and being open and bringing more folks in and being approachable. So I think that's important. But yeah, I think in this moment, it seems to be that people are focused on sort of working through their networks to get to investors. And I think people are doing a lot more reference calls, so you should be prepared for that.
Great insights, great advice and suggestions. Thank you. James, what about you? What are you liking seeing, and what suggestions might you have for founders that are doing this for the first time?
Yeah, I completely agree with Jacqueline. And I guess, yeah, if you don't have existing networks to go through for warm intros, like if you have warm intros, use the warm intros. But if you don't, I guess one thing I'll say, because we do invest in a lot of first-time founders, cold calls can work, just don't cold call the VCs directly. So there's a lot of emails coming in, there's a lot of deal flow coming in, there's more than ever. This isn't typical and not all of these are startup related, but I've clocked in personally at over 6,000 emails in one day before. So if you just throw something in there, it's gonna very likely get lost. So I'd suggest if you don't have existing networks that you can tap into, go try to look around for someone who might be able to give you advice, get the VC's attention, funders' attention. And the reason why this is important, and I'll sort of like pontificate a little bit on this, is because oftentimes VCs ourselves are not very good at explaining what we're looking for on our websites, on our Medium posts, on our whatever it is. But also founders are sometimes not very good at explaining exactly how the company fits into whatever the thing is, or maybe, especially for us in terms of lots of technical founders, not very good at explaining what the thing is at all and what the market for it is. So if you can find someone who is experienced in these areas, potentially has some sort of connection to the VCs, you can get both a referral point, but also a translation layer where they can see and understand what you're doing. And at the same time, they're able to also know what the VC generally looks for and sort of bridge that gap so that you don't end up having a missed connection in the dark just because of some of the translation issues there, or just going into an inbox where you never get seen. I guess as another concrete thing, I'll maybe throw out alongside everything that Jacqueline said, which I think is like completely right. Maybe also just be crystal clear about your milestones, at least for us and some of the partner firms we work with. We're more focused on that than ever because there's still a lot of uncertainty about what's going to happen going forward, right? Hard to say exactly what conditions will be. Is there a bubble, a pop? Is there some sort of issue in terms of the vaccines? What's going to happen down the line? So have a very clear idea about what your milestones are for the next round. Have some buffer in there. And basically be able to very clearly articulate what the VC is, what the funder is buying into for the next round. And I know that that's hard for first-time founders. Like a lot of our own conversations with first-time founders are trying to figure that out. But if you're going to use what was this one? Mentor Cloud or some other means of basically getting a hold of someone to advise you, and you want to figure out what questions to ask, I suggest that question, just in terms of figuring out good milestones for a next round, be on that list.
Really great suggestions.
Nicole, can I add?
Yeah.
Can I add a few more that James like sort of sparked in me? So one, I think I'm seeing a lot of decks that have like a whole slide about COVID and why this is such a great opportunity in COVID. I am hopeful that this is a short-term world that we're living in, and that within the next 2 years, it will have changed in some ways. And I talked about that a little bit before. I think you need to think more long-term and think about how, if COVID is a piece of your narrative, talk about like the thing that it's accelerated that makes for a really great opportunity for you that's going to stick around. Because companies take 5, 8, 10 years. And especially if you're a pre-seed or seed, like it's going to take a long time. And so you just have to think about, think about the world exactly as it is, but know that like the COVID situation and some pieces of that are going to be short term. And so I think investors want to make sure to see you, it's not too much on the short term trend. So that's an important thing to think about. And then the other thing I was going to say, like on the cold inbound piece, yes, it does work. And there are a lot of firms that do like take a lot of cold inbound, and like they have their websites are set up to ingest that, all of that. Do your homework and don't waste your time and the venture fund's time, right? So like when I get pitched a pre-seed deal, it's like pretty clear out there, I think, that like we don't invest in pre-seed companies. And so like don't waste your time and don't waste the investor's time. It may be that you come back to us later. And sometimes I will get a seed company. I'll say, hey, this might be good for this fund. So you never know where it will take you. But do your homework to make sure that you're a fit and it makes sense that you're pitching this firm. They will appreciate that. And don't do the giant BCC thing where it's like, hello, sir or madam. And it clearly you've clearly not done your homework on the firm. It's not personalized at all. It's just like, it's not going to get you anywhere. It's like a waste of bandwidth, really, in inboxes. And then lastly, I wanted to mention, there's something called Fund Board. fundboard.co. I think it's a new startup. It's actually based here in Boulder. A friend of mine is the CEO, and they're working on actually sort of building efficiency and access into this process for founders. And it's free to founders. They're just getting started, but I would encourage you to check that out as a way to navigate this process, figure out where you can get connected to people. And so on top of sort of all the other research you'll do on Crunchbase, and like NFX has put some good stuff out there, I think that's going to be a great new avenue for founders to find funding.
Awesome tips. Thank you guys so much. Okay, speaking of good tips, Craig, into the nitty gritty on term sheets for a moment. Have there been any strange terms that have been popping up, both if you'll indulge at the seed round and then also anything at the later stage? Because I appreciate, term sheets can sometimes get more complex, not always at the later stages. So anything that you're seeing shift as far as the terms around these deals that are getting done right now?
Yeah, actually, if you look at the detailed terms, and we survey this, and I didn't go through it in the slides at the beginning. And we survey liquidation preferences, anti-dilution protections, other standard terms in venture deals. The surprising thing is how little has changed. The terms really are largely the same as they have been for the last 5 or 10 years in a very positive market. I would expect everything is cyclical, and at some point there will be a downturn in the venture market, and that could be in 2021, that could be in 22, it could be in 23. I don't know when it will happen, but at some point deal terms will tighten up. And when they do, when the terms get more difficult for founders, investors are often looking then for redemption rights, where they have the right to, after 5 years or 6 years or 7 years, to demand their money back so they can force a liquidity event. And that's something we haven't seen much of in a long time because terms have been so founder favorable. And historically in down markets, we would see a pay to play provision where investors, where you have a syndicate of investors who have invested in a company. If the company has to do a down round financing in the future, then the investors who don't write a check are somehow punished. That if they have existing preferred stock and they can't write a check in the new round, their existing preferred stock would convert into common or lose certain other rights. There are lots of different flavors of pay-to-play provisions, but that's something again that we're not seeing right now because terms are so company favorable right now, so founder favorable. So for the moment, terms are great. At some point, it will change, and some of these terms are going to be much less founder favorable.
So follow, if you're not already, the insights and reports and perspectives that come out from our friends Wilson Sonsini, because they really do try to get ahead of those things as things may start to shift at some stage in the future, hopefully not for a long time. So Jacqueline, I do want to come back for a moment, because I think it's really important for our entrepreneur community, as well as, of course, the ecosystem at large, to understand the VC and LP landscape, because ultimately the customer of the customer is our customers, right? So how do we start to think and understand what is happening dynamically, perhaps within the venture fund, both emerging fund managers, existing fund managers, the size of the funds, and any changes or dynamics to the LP landscape in general in 2020?
Sure. So the LP landscape, remember, is there's a wide spectrum, right? You've got family offices and high net worth individuals on the smaller end, and then you've got giant institutions like pension funds and endowments, insurance companies on the other end of the spectrum. And fund of funds fall somewhere in the middle, depending on the size of the fund of funds. In the big endowment pension world, this was an interesting year. I think we expected things to be slightly different than they turned out, and so sort of appetite for looking at new things and allocations in Q1, Q2, like sort of March into May, was very much on a halt, because they didn't, if you think about, and foundations are also part of that, the capital outlays that they expected. So if you're a hospital system, right, you don't have, like, you didn't have nearly as much income this year and you're spending a ton on treating COVID patients. If you're a university, you don't have nearly as much on-campus revenue because students aren't there. A lot of students dropping out, having to switch to virtual. So if you think about it, so there was that aspect of it. So they thought like sort of their cash out the door would be higher, which I think did happen for many. but they also expected a denominator effect, and that's mostly focused on their public markets exposure. And so I think everyone expected that the markets were going to tank. And so in sort of gearing up for that, and I think there's still like some fear that it's going to happen at some point because nobody believes that this can continue on for this long. So there was a fear that like sort of if your exposure on the public market side, if that portfolio shrinks from a valuation perspective, then all of a sudden you're over allocated to the private markets, especially private equity and venture. Venture is also not a particularly liquid asset class, and it's patient capital. And so those I think were challenges in thinking about allocating to more in 2020. You might see some making up for that in 2021 by being more open as they reset their allocations and think about what that looks like. All that is to say, there's a lot of money sloshing around in venture. I think you see a lot more LPs just open to it and wanting to build venture books. And a lot of that capital will go to this next generation of emerging funds because there's like limited access to sort of the name brand firms. So I think there's more appetite for the exposure. I think tech is touching everything. It's no longer a sector. It's sort of, the startup culture and tech in general touches all markets, all industries. And so there's just a lot more activity. And so I think there's, more funding appetite because of that. It's also a lot cheaper to start a company than it used to be, with sort of what you need to get going, given the tech stacks that are out there today. So I think we're seeing a ton of money in this market. There's a lot of dry powder. I think it was challenging for any sort of new first time or early fund managers to fundraise this year because LPs want to build relationships with you over time anyway. We were overwhelmed with the amount of funds that were starting up. I mean, there's like 1,000 going to 2,000 funds today, where there used to be like 100 and then maybe a couple hundred, but like it's unbelievable how many funds. And it's mostly in this micro fund emerging manager category, but there's a lot of funds out there. A lot of people want to be a VC. So it's not only overwhelming to LPs, but it's just like if you didn't have, you got to build relationships. These are 20-year relationships, really. Most of these partnerships last almost 20 years for an individual fund. And so hard to build relationships via Zoom on top of you just need to spend time with LPs. So that I think was a thing that was challenging. That said, great time to have new capital as a seed fund because there's so much building and innovation going on. And then the last thing I would say is those that did, those that do have the established brand and the LP base went out to market a lot more quickly than I think we expected because they figured they just might as well, and nobody knew it was going to happen. So you saw a lot of funds coming back to market earlier than their LPs expected, which was a bit challenging from an allocation perspective. So bunch of stuff.
Thank you. Really good updates. All right, so we've got great questions coming in. So I'm going to transition over to live Q&A, but before we do that, we always ask to make sure we don't leave any really good thoughts on the table. What's the one parting takeaway that you want to make sure you have a chance to say before we transition to the Q&A part? Craig, can I put you on the spot and ask you to go first?
Sure. I think just kind of summarizing what we've all been talking about, this is a great time to fundraise. And if you want to raise money, you want to raise money when the market is good. So I would recommend going out sooner rather than later, but always keep in mind what James said earlier, that this is a very binary market. The companies that are able to raise money are raising more money and on better terms than they had expected or asked for. And then you have a whole category of companies that just can't raise money where there isn't a source of funding. So you need to go into this and be persistent and be optimistic, as 45% of the participants in this webinar are, but also be aware that even if this is the best time ever to raise venture money, raising venture money is very, very difficult. And most companies don't succeed at raising venture money. So I don't want to be too negative, but be aware.
Be aware, do your homework, use those tools like Jacqueline and James have referenced. Let's make sure that we are imparting that. Thanks so much, Greg. James, what about you? What's your one key takeaway that you want to make sure that everyone leaves with today?
I think find the right time. Because I think it's easy when you sort of look at sort of popular press and everything. It's like, well, just go raise venture because it's going to accelerate you somehow. If you don't have a good idea of how it's going to accelerate you somehow, it's probably not the right time to go out and do it. Yeah, I know, like, you're running down on cash and everything, and these things like are there. But really, venture and what venture investors typically look for is what are they buying for some of the next rounds. And I think this is one of the perspectives that I usually see first-time founders not quite get as much. It's like, it's not just, I'm a rocket ship, you should invest. It's like, yeah, that's helpful, but you're a rocket ship, and what's the next stop, at least, just in terms of where you're going. So that's an important thing to keep in mind, and especially what we see with a lot of grant funded and other companies just within that sphere that have alternate sources of financing. Figure out what's the inflection point that you're looking to try to get to within the next year that a bunch of unrestricted money could accelerate you towards. That's the key thing to keep in mind. It isn't just sort of a blank check of now we have more runway. It's is the stopping point that we're trying to get to next.
I love that. Perfect advice. Thank you. Jacqueline.
I think I should have mentioned earlier when I was talking about the trends that we're seeing is that diverse teams perform better. And I think we've seen countless studies and anecdotal data. We know it's true. So my advice is to invest in that, both at the firm level and as you're building your companies, because investors care all the way up to the LP level. Yale came out and made a big statement recently. NASDAQ has talked about diversity on boards. So both at the board level and at the company level, especially at the management team level, just think about how well set up you are to build diverse teams if you want to be a best in class company, and know that investors are starting to pay a lot more attention to that.
Fantastic. Well, speaking of what investors are paying attention to, there has been a couple of really good and interesting questions coming in around ESG. And how or where that may be having an impact, both within inside of venture funds, and equally importantly, within inside of those pitches and portfolio companies that you choose to invest in. How, and Craig, to the extent that you've got data around this too, like is social impact, is that CSR lens really playing out as a critical layer with investors' considerations and decisions right now? Whoever wants to answer.
Yeah, maybe I'll go first from what I'm seeing personally and what I'm seeing in the firm, and we don't really track it necessarily. There certainly is more buzz, and there has been for the last several years, about social impact, environmental, and other issues. And in some ways, I think it's impacting public companies more than private companies. That public companies, we see adopting official policies, really taking more aggressive positions on these sorts of issues. For an early stage venture-backed company, at least from my perspective as a lawyer, I'm not seeing it be a tremendous issue. I think VCs are very mindful of some of the issues that, social justice issues that we've been talking about and the impact on founders, but I'm not seeing a lot of venture funds change their themes around requiring social impact policies by companies that are raising seed financings or Series A financings. Not that it's a negative, but I don't necessarily see it as something that that's driving investment strategies by early stage investors.
Mm-hmm, mm-hmm. James, Jacqueline, anything you'd add to that?
So I'm somewhat of a apostate here, just in terms of look, I came from I actually came from the nonprofit world and some of the impact investing world originally, before moving on to something more honest, where I started at Bridgewater. It's very hard to balance two different goals, right? Just in terms of impact, and so whatever your impact metrics are, and the bottom line. My personal perspective is that funds that promise both usually deliver neither, and it's focus on one or the other. For us, our impact comes from the fact that we focus on these huge problems, where if the company gets to scale, that's enough of an impact. If you actually are able to solve a lot of these metabolic disease issues and these healthcare cost issues, you've made a huge difference in a huge number of people's lives. If you're actually able to solve climate change, then yes, you've also made a huge difference in a huge number of lives from scaling that up. So that's sort of our perspective and where we come from it. So yeah, we see this come in cycles. Every now and then, it's like everyone starts promising that double bottom line. We promise you impact, plus you're not going to give up anything in return. The promise gets broken. Everyone loses their faith in it for a while. Then it comes back 5 years later. Anyway, that's my cynical take on it, at least. So
very, very helpful.
I would add, I do think there's a lot more. There are funds out there that are impact focused funds that are getting LP dollars and are in business. I think the important thing is like how you define impact, right? So to James's point, like a lot of his companies will have positive impact on the world, but they're focused on becoming profitable big companies. You also think about job creation, which I think is something where startups in general have a ton of impact. And to the diversity point that I made earlier, I think there's a big equity impact that you can have on how you hire. So I think there's other ways to have impact, to be socially aware, to be good citizens, than having to have the specific mandate on what you're doing. I do think that the next generation of workers they're certainly more woke than us millennials. I'll out myself as a millennial, and want to see. I know a lot of CEOs have struggled with, like, they don't want to be on either side of it, and they sort of wish that we could go back to, you don't talk about religion and politics at work. And my comment is always, like, social justice is not a political issue, it's a human issue, right? And so you've got to be aware that, so I think a place that it comes in a lot is just thinking about the culture that you want to build from a team perspective to be able to attract the best talent. And so that, I think, is where companies are starting to think about it more, in like sort of the smaller companies, not necessarily the corporates. Is just like they want to make sure that they're a place where people want to come and work, and so that is a place where it may play in.
I love it. Okay, well, I'm going to try and attempt to not necessarily do and consume 6,000 emails in a day, but I'm going to try to do 3 last questions, rapid fire, since we're at time, and just whoever wants to answer, let's do this. SPACs, have they had an impact in the way that people are pitching and the way that the money is flowing? I know SPACs, it's what's for dinner. Everyone's been talking about the wild year of SPACs, but what's your guys' take on it?
Liquidity, right? It's allowing for earlier liquidity. It used to take forever to get to IPO. You are seeing really active IPO markets. It's been a great week for a lot of VCs, a lot of companies, a lot of early employees, which is awesome. But I think SPACs do provide another path to liquidity, which we like seeing, and certainly some of our companies have been approached by them.
Amazing. Debt to venture ratio. Any changes or lines of credit or other elements to take into account? Are you advising and seeing your companies pulling down other avenues of capital at the same time of closing a round? Craig, anything you've noted there? James, Jacqueline?
Definitely seeing a lot of debt activity. Silicon Valley Bank is extremely active, and most of our clients that raise equity are raising debt simultaneously with the equity or soon after the equity round. So definitely seeing a lot of companies, startups leverage up with additional debt because it's cheap.
Yeah, there we go.
Yeah. New fintech stuff, some revenue-based models, certain other things. There's some innovation in the space. So yeah, we've definitely seen different folks start to leverage that.
Awesome. All right, my last question, because we have a healthy dose of optimistic entrepreneurs and emerging fund and existing fund managers with us today. Podcast or book that everyone should read in their non-available downtime. What do you recommend? What's inspiring you guys right now out there?
I'm leaving it to you guys because I haven't had time to read a book or listen to a podcast in the last 9 months.
I think I'm like to get to that question. Anything on the wish list? Anything you'd like to be reading or following or catching up on podcasts?
So I like the New Stack podcast for on the VC side of things. It's a good one. Harry Stebbings' 20-minute VC for people that are interested in VC is a fun one. I would say I just did the Acquired podcast. I was just on it with my partner Lyndall. And then on books, I have finally gotten around to reading The Hard Thing About Hard Things, which everyone has probably already read, so I'm way behind on that one. And I'll endorse my partner Brad Feld's new book, Startup Communities, The Startup Community Way. Excuse me, I should endorse it properly, especially for those of you that are building startup communities in places around the country.
Amazing. James?
Maybe a little bit of a boring one, but there's a podcast called, I think, Green Light or something like it, that's helpful for healthcare founders, just in terms of looking at different regulatory issues. There's also another podcast that's at least nominally focused on longevity stuff, and that's some of the more annoying things on my side, but also a really good podcast called Peter Attia's The Drive, I think. Yeah, The Drive, which goes into a lot of interesting issues in terms of healthcare, and you hear from different healthcare practitioners, you hear from different payers, and it's useful to keep that perspective in mind if you're going into healthcare and really knowing some of the players in that market who aren't just your customers, because everyone affects you in that market, not just literally not literally just the providers who are usually the ones who pay you.
Awesome. Awesome. Well, and of course, keep on reading those entrepreneurs reports as they come out for updated and new information. My thanks to all of you today. It's been not only a great hour to spend, but some really amazing information, insights, tips, strategies. Again, if you haven't gotten the report, make sure you do it. We'll be sure to send a link out in this. And speaking of links, I've got one ask of all of you joining us today. Well, actually, I have a couple, but the main one is we can only get better when you tell us what it is that worked for you today and what more you'd like to hear. So please do take a moment to fill out that survey link in the chat box and let us know what you learned, what your takeaways were today, and what more information you might look to learn around this subject matter. Again, thank you all for joining us. It's been great. We've got some good upcoming events that stay tuned for. Happy holidays and keep on being great out there. Thank you guys. Take care.
Thanks so much.
Thank you.
Yeah, thank you.